right, welcome back to the Know Your Numbers REI podcast. This is Chris McCormack, CPA and certified tax planner here at Better Books Accounting. Again, it is our goal to eliminate your fears, frustrations, confusion around the tax code and equip you with confidence in your decision makings. We know that most Americans do not have confidence in their financial decision making, especially when it comes to taxes. And so we are looking to fix that, to bring confidence to you, the American investor and business owner. Today, we're going to be talking about the top 5 write-off mistakes that most people make and how to avoid them. And I have met with hundreds of investors and business owners over the past 3 years. And these 5 things are the 5 that stick out the most to me. I mean, it's not an all-encompassing list. There are thousands and thousands of mistakes that people make when it comes to taxes and planning for taxes, but these are some of the most basic and most common ones. And we're also going to help you out by saying how we can avoid them. We don't just give you information, we help you make better decisions with that information. And that is part 2 of this conversation. So I think we all have the same goal of paying less tax. A few weeks ago, I talked about why taxes are the biggest expense of our lifetime and what you can do about it. Part of that discussion was planning ahead and hiring a professional. Today, we're really going to be talking about some applicable things that you can do in your life to pay less in tax, because there's a large list of things that we're taxed on, but there's not a large list that is easily accessible about what we can do to pay less in tax. So my goal is to equip you with that information by going through each of the 5 mistakes when it comes to taxes and what you can do to avoid them. I think it helps to make clear that most people are, again, looking to pay less in tax, but there becomes a problem when people are so motivated by their desire to pay less in tax that they make a bad financial decision. And that happens more often than not. It happens in the real estate space, it happens in the business space, it happens in the startup space. We are so motivated to pay less in tax that we'll do whatever it takes, even if it makes little to no financial sense. And so these categories that I'm going to go through, I'm going to use real world examples that I've experienced, examples that I've seen, and hopefully it helps you make better decisions when it comes to your tax life, because taxes are one piece of the puzzle. We want your financial health to be ever increasing. We want you to be making decisions that not only positively impact this year, but have a positive ripple effect for years to come, right? And that's why we don't just say park it all in deferred retirement account, because sometimes when you park it all in a deferred retirement account, you're going to be paying more on that money in future years than you would if you just paid taxes on it now. And so these categories, as you'll see, have something to do with that. So with that being said, the top 5 write-off mistakes that people make and how to avoid them. Number 1 is the auto deduction, and specifically the idea of buying a car so that you can write it off on taxes, even if you can't afford it. All right. One thing that we have seen over recent years is the increase in social media. I think it can be great. I think it can also be detrimental. I think that it has a far-reaching impact, far more reaching than we ever thought. But one thing that social media brings us is the access to information. And whether or not that information is good or qualified, we still have access to it. And today, you can go on Instagram, YouTube, TikTok, LinkedIn, Facebook, Google, and search, how can I write off a car on my taxes? And thousands on thousands on thousands of videos and posts will come up. And so what you can do is take that information and say, all right, I got it all, and I'm going to go buy a car and write it off on my taxes without ever meeting with your tax professional, without ever making sure that the information you gathered was right or accurate or applied to you. And you can go buy a car, think you're getting a tax deduction, and then you come to March or April when you prepare your taxes according to it, and you finally meet with your advisor, and you find out that 1, it didn't work, or it didn't work as great as Instagram influencer said it would, or B, you can no longer afford that car. And while you might not have paid taxes on it, you now have a loan that you're paying interest on. And thereby, it has been a costly decision and not a wise decision. And I am all for social media. I use social media. We use social media to help educate you. This is being promoted on social media. It's going up on YouTube. There might be some shorts that are put on Instagram. But the idea is that nobody should be using the stuff that I'm putting out there without first meeting with a qualified professional, or without after meeting with a qualified professional. We always advise you to meet with a qualified professional. It's one of our 3 things you can do to pay less in tax from that previous episode that I mentioned earlier. And so if you're listening to this and you don't have a qualified professional, we'd love to be that for you. At least see if it's a good fit, because we don't work with everyone, and some people it's not a good fit, but we're happy to see if it is. But the number one category or things people that get wrong about write-offs usually has to do with the car and the auto. I have met with many business owners and investors who have gone and bought the latest and greatest truck or the latest and greatest SUV or the latest and greatest van just to find out that they didn't need it as much as they thought they might, or they can't afford it as much as they thought they could, and they're in a much worse position than they would have been if they just paid taxes or looked to a different strategy to pay less in tax. We had a client come to us last month, and they were worried because they had worked with 2 tax professionals in the previous 2 years. So they had switched from one CPA to another. So really you could say 3, or they might have been preparing their taxes on their own. I can't remember. But the point is, they had switched multiple times, and it had gotten to the point of the last straw, the straw that broke the camel's back, because they had met with a CPA. This was the guy that was going to do their tax planning, and they were excited to be working with him, and they couldn't wait to get all these strategies. And then October and November rolled around. They hadn't met with him, and they saw that they were going to have a pretty large tax bill, or they had no idea what their tax bill was going to be, and they had no idea what they could do to pay less in tax. So they heard of this idea that they could buy a car to write off some of their taxes and that it would work well. And they had a family, and they figured, well, we could use a new car. Like, why don't we do that? So they called their CPA and wanted to verify that they could do this, and they couldn't really get a response back. And so they waited a little longer and sent some emails and gave another call. And it got to the point where it was December. They still hadn't had any information, but I believe the story goes that they eventually got an email saying, yeah, you can do that. Let's go ahead and do it. And that was it. They just heard that they could do it. And so they bought what they believed to be something that would help them. It was a van that they could use in business and that they could get a write-off for. Well, fast forward to the preparation of the taxes, and yeah, come to find out they can get a write-off. But when they had the conversation with me last month, a few months after their taxes were done, they were like, we don't need the van. We don't use the van. We don't need the van. I'm not even sure if we did it the right way. We're worried and a little fearful because this was the only piece of advice we got. It wasn't good advice. And now we have a van that we would probably be better off without, because now they're expecting their 4th kid. Obviously, a van holds a lot of people, but it also takes up a lot of money. I think it was a $60,000 van that they financed. And so they got a write-off. They paid less in tax, but now they're stuck with something that they don't want to be paying for and they don't even use. And so to avoid that, we need to have an approach that is in line with what we want to do and what we want to be and who we want to become, right? I was listening to Jordan Peterson recently, and he was talking about vision. And when you have a vision, you can make decisions based on how they line up to your vision, right? You can have a vision of being a loving husband and a father who provides and somebody who cares for his family. And then the idea of going and cheating on your wife comes in, and you say no, because that's not who I am. It's not what I do, and I'm going to love my wife and provide for my family. But without that vision, that temptation becomes more and more of a viable solution. And I put that in quotes because it's not a good solution, but those who cheat on their spouse don't have a vision for what they want to be as a spouse, or that vision doesn't line up with what they think will bring them the highest amount of pleasure. And so they go and commit this terrible offense. And in the same way, if you don't have a vision for your life, for financially or from a tax perspective, then any old tax deduction is going to seem like a good idea, regardless of what the ROI is, regardless of what the use is, regardless of what value it provides to your life. Okay, I can write off a vehicle, so why don't I go and buy the latest and greatest vehicle, even though I don't need it? That's what happens when you don't have quality tax advice. So the first mistake people make is in the area of cars. And it comes largely because of you're not meeting with your CPA. Your CPA isn't advocating for you in the way that he should and telling you, hey, yes, you can write off a car, but does it make the most financial sense? Or you're getting stuff from Instagram and Facebook and LinkedIn and YouTube and not vetting that information or seeing how it applies to you. Secondly, meals and entertainment. Now, this can go one of two ways. One way is that people aren't using this to the best of their ability. Maybe they don't write off any meals, even when it's with a business partner or when it's with a client or when it's with travel at a business conference, because they heard that meals and entertainment is a red flag in the IRS. That is a mistake that many people make. The other mistake people make is writing it off too much. I've had people who have come to me as prospects and they're like, yeah, here's my income statement, here's my bank statement, it has everything on it. And then I go through the transactions and it's like every single day they're eating out breakfast, lunch, and dinner on their business card. I'm like, yeah, okay, that's a red flag. When you're spending $10,000, $20,000, $30,000 in meals and entertainment, that is a quick way to get the IRS on your back when you have no evidence to back it up. So the mistake is that you either aren't using meals and entertainment or you're using it in a way that is outside of the way that the IRS has given us. Because believe it or not, folks, there is guidance and regulation that is pretty clear as to what you can write off and what you can't write off. And now there is some gray area that you should be working with a tax professional to discover what that gray area is and how far you can go with it. But there's also clear instruction that you can use meal and entertainment when it's for business purposes, but it's 50%. And so another mistake would be writing off 100% of your meals and entertainment deduction, when the IRS clearly says that only 50% of that expense is deductible. And this can be confusing because in 2021 and 2022, the tax law was that 100% of your meals and entertainment could be deducted. I think it was 21 and 22. It might have been 2020 and 2021. But the idea was that there was 100% deduction for meals and entertainment. So what people will do is like, oh yeah, 2021, 100% deduction. Now I can get 100% deduction for the meal that I just went out with. Even if it's with a business partner, you might assume that $30 Chipotle meal is 100% deductible, but that's not true. It's not, it's 50%. And so what you don't want to be doing is 1, having every meal out because those aren't deductible. 2, writing off meals that aren't business related. That's not deductible. But 3, also not substantiating it, right? I am all for writing off meals with business partners or clients or travel, but having evidence to prove that it is crucial. Otherwise, they're going to throw it all out. So auto is a huge mistake that people make. Meals and entertainment is another huge mistake people make. Mistake number 3 is clothing. How many of you think that you can write off clothing? And many of you might be thinking, well, yeah, if I have a business purpose, that would be great. And again, remember I mentioned that the IRS is pretty clear on some of these things. Clothing is one of those things. They say that you cannot write off any clothing unless it has a logo on it or it is 100% business related, right? So for my nurse practitioners out there or those who wear the scrubs, like something like that is business related and you can get the tax deduction for it. However, this shirt that I'm wearing, if you're not on YouTube, go check us out. I'm wearing a shirt. It is a button-down shirt, blue and white. And I did buy it with business in mind. Like I could wear it on podcasts. I could wear it for client meetings. I could wear it. It's a nice shirt. I like it because this shirt, while yes, I bought it with business in mind and I'm using it right now for business, the IRS clearly lays out that we cannot deduct clothing. Why? Because I can also wear this to a graduation party. I can also wear this to a wedding reception. I can also wear this to a church service. Like I can wear this shirt for many other reasons outside of business. So no matter how many suits I buy on the business credit card, I can't write any of them off because there is little to no availability for me to prove that it's 100% business related. And so the IRS is very clear about that. I don't really care what the Instagram influencer says or what you think about buying something for business and being able to use it for your brand. The IRS has clearly laid it out for us that clothing is not tax deductible. And I'm just as disappointed as you are. I wish that wasn't the case. I wish I could have written off this shirt because look, I'm on camera and I am putting this out for business related purposes, but because the IRS has said that, I have to abide by what they have said. Number 4 is business travel. Okay, so remember that time where I was saying that just because you can deduct something doesn't mean that you should deduct it. This is the category where I see that along with the auto deduction and really any of these, right? The point is that just because I can deduct a first class ticket doesn't mean that I should always buy the first class ticket, especially if it doesn't make financial sense or that $200 that I'll be spending extra for first class can be spent somewhere else that gives me a greater return on investment, right? Just because it's a deduction and it is a viable deduction does not mean that I should take it as a deduction because I can just take a regular plane ticket and get from point A to point B in the same amount of time and I will result in the same amount of emotional well-being, right? A little extra foot space, maybe it makes sense. If you have the money for it, then go ahead and do it. But for those that are looking to be wise with their money and a good steward with their money and trying to take into account not only taxes, but their overall financial well-being, does it make more sense to splurge on first class or does it make more sense to save that money for a vacation with your family or to invest that money in the stock market or to put that money for the next down payment on your property, right? These are the things that we should consider. Just because it's a deduction, just because you're able to deduct it, doesn't mean that you should. That goes for the auto. Just because you can buy a car and write it off on your taxes doesn't mean you should. Just because you can buy a meal and write it off on your taxes doesn't mean you should go to the Michelin star restaurant and spend $1,000 in the restaurant because the IRS also says that it can't be extravagant and you can't be spending an outlandish amount of money on meals and entertainment for business purposes because you can just as much go to a Chipotle and have a business meal there. And just because you can write off the first class ticket or dare I say the private plane doesn't mean that you should, right? Nowadays, you can spend $10,000, $20,000, $30,000, and you can get a private plane. You save time. You don't have to go through security. They treat you like a king and you get to your place. But what's the best use of that $30,000? Is it to save taxes? Then I don't know. I would be far stretch to say that the best use of $30,000 is to buy a private plane ticket, when in reality, I could get you more of a deduction by putting that $30,000 down on a real estate property, appreciating it, and doing some strategy there. The last mistake that many people make is in the area of hiring kids. Now, before you go and get crazy on me and say, yeah, but Chris, you can hire kids. Like, I've seen it done and I've heard it done. Trust me, I am a firm believer in hiring kids. I've said it on episodes before. I love getting the family involved in business. I think it's one of the best things you can do. You can teach kids at a young age the power of entrepreneurship, working for yourself, building wealth. It's great. But the mistake comes when you do it the wrong way. Mistake comes when you do it the wrong way. We can hire our kids and not do it properly. We can pay them way too much. We cannot document everything we need to document. And it might work in the short term, but in the long term, when the IRS comes and sends you a notice of audit, you're going to wish that you did this the right way and that you didn't make these mistakes. So believe me when I say hiring kids is a great strategy done the right way. You can't pay your 7-year-old $14,000 when they only did $200 worth of work. You can't pay your 14-year-old $7,000 when they only did $2,000 worth of work. You can't pay your 12-year-old $14,000 when there is no contract and they only did $0 worth of work. You have to pay them just as you would any other employee. And that is a mistake that many people make. And that is a mistake that we want you to avoid. And so you should take this as your warning. If you're considering hiring your kids, if you're considering writing off business travel, if you're considering meals and entertainment, if you're considering buying a car, if you're considering clothing and what you should do about it, you must hire a professional. I am telling you, there is a great return on investment with working with a qualified tax planner who knows the tax code. Because many people, many accountants will take your reports and see that you spent $5,000 on clothing. They won't ask any questions. They'll put it on your taxes. And then guess who's in trouble when the IRS comes knocking? It's usually not the accountant, although there is a liability risk that they have to consider. But it's you. You're going to be the one that's going to be paying the interest, the penalties, and all of the other stuff like taxes. It's not good. So get ahead of this. Defeat it before it even comes up by hiring a professional, planning ahead, and doing this the right way. Planning ahead and doing it wisely, right? I will help you. We have plenty of clients who use the auto and buy cars that they use in their business, and they are more wealthy as a result of it. They have paid less tax and it makes more sense. But I've seen a lot of other clients as well, before they were clients, they've used this, buy a car and write it off, and now they're stuck with a car that they don't use or can't afford. I've seen a lot of clients make use of the meals and entertainment deduction. I've seen a lot more prospects either not make use of it or use it improperly, try to write off far too many things, and then they have less money to pay taxes that they owe. And so to avoid that, to avoid going in debt to the IRS, to avoid making mistakes that can cost you interest and penalties and audits and headaches, hire a professional. Whether it's us or someone else, we're happy to see if it's a good fit. We so love and appreciate you guys listening to this podcast and following along. If you get value, leave us a review. If you think of someone who might get value out of it, go ahead and share it. If you're new to this show, subscribe, like, and keep following along, because it is our goal to help build your confidence to the highest degree. I thank you all. I love you all. God bless, and keep moving forward.